Although location is crucial for investing in real estate successfully, let's cover how your financing makes even the greatest deal fall apart. Welcome back. My name is Blake Alewelt, owner of the Bravo Ridge Group. In this video, we go over important steps you need to know in order to make money in real estate. Understanding everything involved with real estate finance can be challenging. Apart from getting your finances in order, you must keep track of your investments and the health of the real estate market. Additionally, as your investment portfolio grows, funding sources change, and there are additional factors to consider when financing new deals. This video is a comprehensive guide to real estate finance and how to prepare for purchasing your next investment property. So what does it take to become a real estate investor? What should your finances look like before you get into your next deal? And is it possible to invest in real estate with little to no money? Stay tuned to learn the best financing tips for real estate investors. What is real estate finance? Real estate finance refers to various funding sources available to property investors. For real estate rookies, the most common source of financing is a conventional loan to buy a rental property. The finance used to pay the mortgage, rehab costs, and relevant taxes and fees. Real estate investing for beginners and how to get your finances in order. To get into real estate, you must clearly understand your current financial situation. Before applying for a loan or buying an investment property, you should have sufficient cash reserves. In addition, having a good credit score, low credit utilization, and an acceptable DTI or debt-to-income ratio are vital. Your debt-to-income ratio is a percentage that tells lenders how much money you spend paying off debt versus how much money you have coming into the household. These factors ensure you are not a borrowing risk and help you secure better interest rates on a conventional or personal loan. Now keep in mind that there are other methods of financing these purchases. So let's look at what it means to get your finances in order to start investing in real estate. Number one is your current assets. Before buying an investment property, the first thing to consider is what you own now. These can include your home, cash reserves and savings accounts, and your 401k retirement account. It may be possible to use the equity in your home or savings to put toward a down payment on an investment property. For those of you who don't know, equity is the difference between what you owe on your mortgage and what your home is currently worth. So ask yourself, how much are all your current assets worth? Do you need to have more savings before you buying a rental property? Or would it be best to build more equity in your current home and apply for a home equity loan later? These are crucial questions to answer to make a good investment. The next is your personal income. When applying for an investment property loan, a lender will consider your current income. Of course, you expect real estate investments to generate regular monthly cash flow, adding to this monthly income. However, lenders usually want to ensure you already have a stable income, enough cash reserves to pay the equivalent of 6 to 12 months worth of mortgage payments. Now remember, you will need substantial cash reserves for a down payment when applying for an investment property loan. Therefore, the more you can save before buying an investment property, the better. Then there's the cash for a down payment. Getting enough cash for a down payment is one of the biggest challenges of financing your first property. New investors typically need enough cash to make the down payment between 20 and 25%. And while it may be possible to get a conventional loan with a 15% down payment, a larger down payment will secure better interest rates. You can also try house hacking, which is an investment strategy in which your investment property is also your primary residence, and you can rent out rooms or separate units. This also comes with the opportunity to put even less money down utilizing the different loan products that we'll cover later on in the video. However, it's good to remember you will need cash reserves for more than just your down payment. Most lenders expect you to have at least 6 months of liquid reserves, usually cash. Additionally, you need to have enough funds to ensure a rental property passes state inspections, make any upfront repairs, and cover potential vacancies right out of the gate. These factors can also affect how much cash you need to start investing in real estate. The next is your credit score. Your credit score is one of the most important factors when getting your finances in order for real estate. A good credit score of at least 670 will mean you could secure lower interest rates on a conventional or personal loan. In addition, it will allow you to build passive income from real estate faster. If you currently have a poor to fair credit score, you must take steps to improve it. 2 easy ways to get your credit score in order are to lower the credit utilization and simply start paying your bills on time. As you start investing into real estate, you'll realize the bills only get higher and more plentiful. So learning how to pay bills on time now is a great habit to build. Then there's your credit utilization. This factors into your overall credit score and thus becomes an important part of getting your finances ready for real estate investing. Your credit utilization ratio is based on a revolving credit, your credit cards, and personal lines of credit. It is simple to calculate and how much credit you are using. Simply divide the amount you owe by the total limit of your cards. Before investing in real estate, what can you do to fix your credit utilization? First, ensure your rate is always below 30%. For example, suppose you have a total credit limit of $10,000. The revolving balance should never exceed $3,000. If it exceeds 30%, you should work to pay off more of your credit card debt before applying for any loans. Which brings us to your debt-to-income ratio. Getting real estate financing in place requires calculating your debt-to-income ratio, or your DTI. This is a percentage that tells lenders how much money you spend paying off debts versus how much money you have coming into your household. A lower DTI ratio increases the chance of your loan application being approved. How can you calculate your DTI? First, you must divide your monthly debt payments by your gross monthly income. This means before taxes are taken out. The resulting number shows how much of your income is currently going towards debt payments. A DTI of 43% or higher is usually a bad sign to lenders. This key takeaway is all this: reduce your debt before investing in real estate. This is vital to purchasing your next rental property or to start flipping. Now let's get into the good stuff, your loan-to-value ratio. The loan-to-value, or LTV ratio, on an investment property is also a risk factor that lenders take into account. This figure represents the amount of a secured loan not covered by your down payment. Typically, most lenders require an LTV ratio of less than 80%. Therefore, having substantial cash reserves to make a larger down payment can reduce your borrowing costs and ensure a greater return on investment in the long term. Simply put, your LTV ratio is the amount of your mortgage divided by the value of the property. For example, if you put $100,000 down for a $500,000 home, your LTV is 80%. Before we dive deeper into the types of financing that you can use for your investments, I ask that you hit the like and subscribe buttons down below so that way we can put out more content specifically tailored to you. Now let's get to the fun part: how to finance your real estate investments. Real estate finance is part of an investment strategy to make money from property investments. Most investors rely on financing options to spread the cost of buying the property over several small payments, whether through normal banks and lenders to private investors. However, the only way to get a loan approval to buy a rental or fix and flip property is to prove that your finances are in order. Here are how your finances should look before making any investments. You have enough cash reserves to make a sizable down payment to lower the LTV. Ensure you have a good to excellent credit score. Pay off as much credit card debt as possible to lower your credit utilization ratio. Get debt payments in order to lower your debt to income ratio. Have cash on hand to cover mortgage payments for at least 6 months. And have cash on hand for unexpected costs that occur when taking ownership of a property, because they're bound to happen. While these factors outline the best case scenario, it is possible to finance real estate even with poor credit and little to no money down. Partnerships and creative financing can give you additional avenues to start your portfolio. So let's talk about a few different types of lending you can utilize. Once you are sure you have a stable financial situation, you are ready to think about real estate finance. Here are some financing options for funding your next investment. The first is a conventional loan. This is the most common source of financing for us investors. Banks, credit unions, loan associations typically have good interest rates and are transparent. They also adhere to lending standards set by Freddie Mac or Fannie Mae. Then there's your private money lenders. Going to a private lender can be a good option if you don't qualify for traditional financing. The private lender functions like a bank with fewer stringent requirements. Then there's the hard money loan. If you're looking for a short-term loan for house flipping, hard money loans may be a good option. Typically, you benefit from flexible repayment options and don't need to worry about your credit scores. However, hard money loans have higher interest rates than conventional mortgages. Then there's the home equity loan. If you're already a homeowner, you can use the equity in your primary residence as a source of real estate finance. The home equity line of credit, or HELOC, lets you borrow a portion of your equity without affecting your current mortgage. So it's good for those of you that locked in the 2 to 3% mortgages. Then there's the VA loan. If you're a veteran like myself and want to start investing in real estate, a VA loan may be a good finance option. With this loan, you could start investing with no money down and buy a multifamily property with up to 4 units. However, you must live in one of those. I recommend using this one if you want to buy a house and rent out rooms to friends that are all serving together. Then there's the FHA loan. You can get a Federal Housing Administration loan if you plan to start real estate investing by house hacking, an investing strategy in which your investment is your primary residence and you rent out rooms or units in the single family or multifamily property of 1 to 4 units. The loan terms require that you live in the property for at least 12 months. Then there's the 401k loan. This loan allows you to borrow from your retirement account and can be a useful real estate finance option if you have significant savings. Which brings us to financing your future as a successful real estate investor. A robust real estate investing business plan gives you a foundation for success. You can enjoy healthy cash flow from your real estate investments. Many first-time landlords find that regular monthly rent payments supplement their regular income or even replace their W-2 job. Flipping real estate allows us investment opportunities to look for more diverse ways of expanding our portfolios. Moving forward, you will find that real estate financing options change. For example, there are limits to the number of mortgages you can take out. Many lenders are reluctant to approve more than 4 mortgages to real estate investors. As an investor, you must consider additional real estate financing methods. For example, building substantial cash reserves can make it easier to secure private money loans, hard money loans, or even self-finance a new investment. Also, making a larger down payment reduces your total LTV ratio, thus helping to secure mortgages at competitive rates. Then there are the DSCR loans, or debt service coverage ratio loans, which can use the income of the property to cover the mortgage, and they can even go out to 40 years. Real estate investing starts with getting your financial situation in order. This will help you build a portfolio of investment properties. And although it is possible to invest in real estate with little to no money, having enough cash to make a larger down payment minimizes the risk of failure. In addition, having a good credit score, low credit utilization, and a low debt-to-income ratio helps secure lower interest rates and better mortgage deals. Get these factors in place from the start, and you will speed up the time it takes to profit from real estate investing. Once your finances are in order, you are ready to choose the right deal strategy for you to build your wealth. Hit the like and subscribe buttons down below, because in the next video, we cover over 10 strategies you can use to build your portfolio, some of which I bet you haven't heard of. If you have any questions in the meantime, please feel free to reach out directly. I'll leave my contact info down below. I look forward to hearing from you.